And get this, the portfolio turnover rate is a whopping 509%. This means they are buying and selling investments extremely frequently, suggesting a very active trading strategy within the fund. When we look at what the fund actually invested in, a huge portion, 96.4%, is in common stocks. This means they are primarily investing in shares of companies. Looking at the sectors, technology is the biggest chunk at 35.3%. That makes sense given how much the market has been driven by tech companies lately. Financials are next at 12.6%, followed by industrials at 10.1%. And who are they holding? Unsurprisingly, the big tech names are dominating the top holdings. Nvidia Corporation and Microsoft Corporation are each around 6.6% of the fund's assets, followed by Apple Inc. At 6%, Amazon, Alphabet, Broadcom, these are the usual suspects in the performance. Driving stocks of the last few years. It is clear the fund is heavily invested in these mega cap technology companies that have been leading the market. This is a key part of their strategy, especially given the I theme they mentioned. The report also states there were no major changes in the fund's investments during the year. This suggests they stuck with their core strategy and holdings. They also have a code of ethics that applies to their main offices, making sure they act responsibly. It looks like there were no changes to this code or any waivers granted during the reporting period, which is generally a good sign of stability and adherence to rules. The board has a designated audit committee financial expert, Mark H. Taylor, who is independent. This is important for ensuring financial oversight and rigor. For services related to auditing their financial statements, the fund paid around $17,500 in 2025 and $17,250 in 2024. These are audit fees, basically the cost of getting their books checked by an external auditor. They also paid some tax preparation fees, around $4,000 each year. Now for the really granular stuff, this is the schedule of investments. It lists out every single stock and other investment the fund holds. It is massive, showing hundreds of individual holdings. Here we see companies like the Interpublic Group of Companies, Inc., in advertising and marketing, and the Boeing Company in aerospace. They hold stocks in a very wide range of industries. They own shares of Boeing, a company that has been in the news a lot lately for various issues. This shows the fund isn't afraid to invest in companies that might have challenges but are seen as having long-term potential or offering opportunities for their strategy. In banking, they hold shares of Bank of America, Citigroup, and JP Morgan Chase and Company. These are some of the biggest banks in the US. In the biotech and pharma sector, they've got positions in major players like AbbVie, Amgen, and Eli Lilly and Company. And of course, a big stake in Amazon.com, Inc., which is listed under e-commerce discretionary. Looking at semiconductors, the fund has a significant holding in Nvidia Corporation, making up 6.6% of its net assets. This is a huge position, reflecting the current market's focus on AI and graphics processing units. They also hold a large amount of Microsoft Corporation stock, another tech giant driving much of the market's recent performance. This statement shows what the fund owns and what it owes. On the asset side, the investments are valued at fair value, which is over $45 million. They also have some receivables, like money they are owed for dividends. On the liability side, they owe money to their broker, and there are also accrued expenses. The net assets, which is the total value of the fund, is about $43.7 million. This is calculated by taking the total assets and subtracting the total liabilities. For Class I shares, the net asset value per S-share is $17.02. This is what each share is worth at the end of the reporting period. It is important to note that there is a redemption fee if you sell your shares too soon, within 60 days of buying them. This statement shows the fund's income and expenses over the year. Their total investment income, mostly from dividends, was about $459,000. But their expenses were much higher, ringing in at almost $880,000. This includes advisory fees, short selling expenses, and various administrative costs. Because expenses were higher than income, the fund reported a net investment loss of about $421,000. This means that just from holding and managing its investments, the fund spent more than it earned in income. However, the big story here is the gains from investments. They had a net realized gain of over $677,000 and a massive net change in unrealized appreciation of over $3.6 million. This is where the market's strong performance, especially in those top tech stocks, really made a difference. All in all, the fund saw a net increase in net assets of about $3.87 million resulting from operations. So even with the investment loss from day-to-day income, the growth in the value of their investments greatly outweighed it. These statements show how the fund's net assets changed from the beginning of the year to the end. they give a year-over-year comparison. For the year ending September 2025, the net increase from operations was that $3.87 million we just talked about. For the prior year ending September 2024, that increase was even larger. Over $10 million, this shows that the fund's performance can be very sensitive to market conditions. Looking at share activity, there were more payments for shares redeemed than for shares sold. Specifically, over $3.3 million was paid out for redemptions in 2025, while only $1.2 million came in from new share sales. This indicates that investors, on balance, were pulling money out of the fund this past year. This section provides key per-share data and ratios over several years. It is a great snapshot of the fund's performance and cost efficiency. The total return for Class I shares in the year ending September 2025 was 9.81%. This confirms the earlier performance number. Looking back, the total return was 30.14% for the year ending September 2024 and 7.49% for September 2023. So, while last year was good, the year before was even better, showcasing the volatility in returns. Now, about costs, the ratio of gross expenses to average net assets before any fee waivers was 2.13% for 2025 and 1.92% for 2024. This means the cost of running the fund as a percentage of its assets went up slightly this past year. The net expense ratio, which takes into account any fees the advisor absorbed, was also 2.13% in 2025 and 1.92% in 2024. So despite potential agreements to keep costs down, the actual expenses relative to the fund's size increased this year. And that extremely high portfolio turnover rate we saw earlier, it shows up again here at 509% for 2025 compared to 449% in 2024 and a much lower 6% in 2021. This confirms they are actively trading a lot, which can lead to higher transaction costs and potentially taxes for investors. These notes provide crucial details about how the financial information was prepared. It explains the accounting policies. The fund is part of the Northern Lights Fund Trust III, a Delaware statutory trust. It started operations in late 2012 and aims for long-term capital appreciation. They explain how they value their holdings. For stocks traded on exchanges, they use the last reported price. If prices aren't readily available, they have a process to determine fair value, involving the advisor and potentially outside experts. They also discuss the fair value hierarchy. Level 1 is for easily observable prices, Level 2 for other observable inputs, and Level 3 for unobservable inputs, meaning more manager judgment is involved. The good news here is that for this fund, almost all of its investments, over $45 million worth, are in Level 1 assets, meaning they are valued based on readily available market prices. This indicates a lack of investment in complex or illiquid assets that would require significant subjective valuation. This explains how they record buying and selling of investments and how they recognize income. Here we learn that Dakota Wealth Management LLC is the investment advisor, charging a management fee of 1.25% annually. For the year ending 2025, this amounted to over $516,000 in advisory fees. The advisor has agreed to cap total annual fund operating expenses, excluding certain items like brokerage fees and borrowing costs, at 1.99% for Class I shares until early 2026. This is a commitment to help manage costs for investors. This section often contains news that happened after the reporting period ended, but before the report was published, and here is something significant. On the 19th of November, 2025, the board approved an interim agreement for Persimmon Capital Management LP to take over as investment advisor from Dakota Wealth Management LLC. They also approved advisory agreements with Hedgeye Asset Management LLC and Title Investments LLC. These changes will be effective until shareholders approve them or for about 150 days. This indicates a major shift in the fund's management. This is the auditor's letter giving their stamp of approval. RSM US LLP states that the financial statements present fairly, meaning they believe the financial reporting is accurate. They've been the auditor for investment companies associated with Dakota Wealth Management since 2017. This is a pretty detailed explanation of why the board renewed the advisory agreement with Dakota Wealth Management. Even though a change in advisors is happening soon, they looked at the nature of the services, especially how the advisor managed risk with that hedging program, and the performance over different timeframes. They noted that while the fund underperformed the S&P 500, it did better than its peers over the long term. The board acknowledged the advisory fee and expense ratio were higher than average. However, they accepted the advisor's justification that active trading and a complex strategy like this warrant higher fees. They concluded the fees were not unreasonable. They also discussed economies of scale. meaning that as the fund grows, the cost per dollar invested should ideally go down, but they agreed to wait and see. The board reviewed the advisor's profitability and found it to be modest, not excessive. Ultimately, the board decided that renewing the advisory agreement was in the best interest of the fund and its shareholders, based on all the information reviewed, including the quality of service, performance analysis, and fee structure. This section really delves into the rigorous process the independent directors go through to ensure the fund is run in the investor's best interests. It is a testament to the governance required in the investment management industry. Now, looking at these results more broadly, the Persimmon Long-Short Fund is clearly navigating a complex market. They've successfully capitalized on the strong performance of large-cap tech stocks, and their overall returns for the last year are solid. However, the high portfolio turnover and above average expense ratios are definitely things investors should be aware of. The recent management change also signals a potential shift in strategy or a response to performance or other factors not fully detailed here. The fund's performance, while good in absolute terms, has lagged behind the broader S&P 500 over the last decade, which is a crucial point for long-term investors, but their strategy of using hedging to manage volatility, even if it detracted slightly this past year during sharp V-shaped recoveries, is a core part of their offering. A key takeaway is the active management approach. High turnover means constant buying and selling, which can generate short-term gains or losses and incur trading costs. The fact that most of their assets are in level 1 investments is a positive for valuation transparency. The recent shake-up with new advisors suggests the fund is actively seeking to optimize its strategies or leadership. Alright, that is our breakdown of this Persimmon Long-Short Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the new management will boost performance or bring costs down? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into corporate and financial documents. Don't forget to check out the Discord community linked in the description below for more discussions. Thanks for watching, see you next time.